In the mid-1990s, Wall Street believed it had finally solved risk. Markets were becoming more efficient. Data was improving, and mathematics promised something evolutionary: predictability. For the first time, finance wasn't being driven by instinct or emotion, but by equations. And at the center of this belief was a hedge fund so confident, so respected, that banks trusted it with almost unlimited money. Its name was Long-Term Capital Management, or simply LTCM. LTCM was not an ordinary hedge fund. It was founded by John Merriweather, a legendary trader from Salomon Brothers. But what truly set LTCM apart were the people behind its models. Two of its partners were Nobel Prize winning economists. Their work had reshaped modern finance. They believed markets behaved rationally, that price differences were temporary, that volatility could be measured, controlled, and exploited. Banks didn't just invest in LTCM. They trusted it. They lent the fund billions of dollars, often without fully understanding the risks. After all, how could the smartest people in finance be wrong? LTCM's strategy seemed elegant. They searched for small price differences between similar financial instruments, especially government bonds. When prices drifted apart, LTCM would bet they would eventually move back together. The profits were tiny, but leverage changed everything. For every dollar of actual capital, LTCM borrowed dozens more. At its peak, the fund controlled positions worth over $1 trillion, with just a few billion of its own money. The trades worked, again and again. Confidence grew. Risk felt distant. What LTCM underestimated was not the math. It was reality. Their models assumed markets would remain liquid, that price movements would stay within historical ranges, that extreme events were unlikely. But markets don't always behave logically. They behave emotionally. And in 1998, something unexpected happened. Russia defaulted on its government debt. Global investors panicked. Instead of moving together, markets moved apart. The very price relationships LTCM relied on began to break down. Losses multiplied. Positions that were meant to be temporary became traps. As panic spread, liquidity vanished. LTCM couldn't exit its trades, and suddenly, the most sophisticated hedge fund in the world was bleeding billions. Banks realized something terrifying. If LTCM collapsed, it wouldn't fail alone. Its positions were woven into the global financial system. A forced liquidation could trigger a chain reaction across markets worldwide. So the unthinkable happened. The U.S. Federal Reserve stepped in, not with taxpayer money, but by organizing a private bailout. 14 major banks injected capital to prevent LTCM from collapsing. The smartest fund in the world was saved from total failure. Barely. LTCM was dismantled. Its models didn't disappear, but the illusion did. the crisis revealed a dangerous truth. Halpern's math does not eliminate risk, it can hide it. Leverage magnifies confidence and destroys margin for error. The lesson was clear. Markets can stay irrational longer than any model can survive. Long-term capital management didn't fail because its people were foolish. It failed because they believed they were immune to uncertainty. And the world nearly paid the price. This is Cash and Chronicles, where money, history, and decisions collide.